of people haven't showed up yet, but we're going to be respectful of your time. Go ahead and grab some food.
Yeah.
And shortly here, after you grab food, sit back down. We're going to have Jordan give us a presentation about credit. This is not credit repair. This is credit. This is the company that we use to pull our credit into our applications and work the application for that. So it's not just credit repair, although he is a credit guru. So he has an awesome presentation. I understand, Jordan, this is your third time today. So
yeah, already I'm warmed up. So
wow. All right. So I'll let you take it away.
Awesome.
Well, maybe in a minute after they sit down after getting food.
Yeah, let me know when you're ready.
Okay.
Do you know what the food is over here?
So what?
What the food?
Look at my receipt. It is club sandwich, and the wraps are chicken Caesar and buffalo chicken. Chicken Caesar and buffalo chicken. So I guess
Sounds
that's
good.
they're not.
They just didn't have it marked.
They don't have a mark. Oh boy. I think that was the chicken, the regular chicken. Only.
I think we all want to like hang out where Don Peters is. Don, are you tuning in from the beach? I love that.
Yes, we're in Nags Head.
Awesome. Look at that. First time doing a presentation in the Outer Banks, so thanks.
I think we had a little bit of confusion. We got people online. We had at least one person go to the location we had it last month. So we might have some other people that actually went over there as well. So we will see. Let's just go ahead and get started, and we're recording it. So hopefully people will be able to watch it if they can't make it. Yep.
Sounds good. All right, so good afternoon, everyone, and appreciate you jumping in here. We're going to cover a lot of informative information today, and my number one goal is to make sure that all of your questions are answered. So, if you have a question, feel free, unmute, ask away, use the chat, hit up Alan and his team. And I just want to make sure that nobody walks away with having the question unanswered. If you didn't hear Alan earlier, my name's Jordan Goldberg. I am not a Movement Mortgage employee. I work for a company called Zactus, formerly known as Credit Plus. And we are the credit reporting company that Movement uses. So whenever you have a client, you're referring them over to Alan and his team. They pull that credit report and a lot of other verifications through my company, Zactus, right? So we've got credit reports, employment verifications, just pretty much everything that we have to verify on a borrower runs through my company. But today we're going to focus on the credit report piece. I've been in this industry for about 30 years. I've done the credit reporting side of it for 20 years. I was also a loan officer for about 10 years. So I do understand that side of the business. I've been with Zactus, or formerly Credit Plus, since May of 2008, right? So 14 years with this company. I love what I do. I'm super passionate about it. I love helping people be able to buy a house, right? Because at the end of the day, we're all on the same team working towards that same goal, right? Doesn't matter if you're mortgage, if you're realtor, insurance, credit, we're all working towards the goal of getting somebody a mortgage loan, right? And my side of this, my piece of the puzzle is super important, right? It's all about somebody qualifying for a mortgage, the interest rate they're going to get, the mortgage insurance premium that they will pay, right? That credit score is super, super important. There's a lot of stuff we're going to cover today, a lot of information about, what makes up the credit score. We'll talk about changes to the credit score recently, some stuff that's coming down the road. And then again, we'll give you tips, advice, stats, trends, and answer all of your questions. So I hope you have fun with this. You'll see that I'm not a boring guy. I'm not going to bore you to death with all kinds of stats and information that you're going to forget about. I'm going to engage you. I'm going to ask you a lot of questions, and I want to hear what's on your mind. The market. Right. None of us can control the market, right? We don't control interest rates. We don't control how many houses are available, the inventory. But I can tell you my 30 years in this industry, people always need mortgages. They always buy houses, right? There'll be ups and downs, but we always get through it and we always prosper. So let's jump right in. Let's see what we got here today. Cover some true false questions. I want your participation here. I know that Alan and his team have lots of sandwiches to give away, for correct answers. So that's your prize today. My advice versus Dave Ramsey's advice, the tools that Alan and his team use to make sure that we don't miss opportunities, right? The days of telling, somebody you can't buy a house, you're not eligible, right? I mean, that's the past. Nowadays, you may not be able to go out this weekend and make an offer on a house, but we can give you some guidance. We can give you an action plan, steps to take where a month from now, 2 months, 6 months from now, if you follow this plan, you'll have scores and you'll be eligible to buy a house. We'll give some examples of the success, the tools that, the movement team uses, to, again, make sure that nobody misses an opportunity. All right, so first question for everybody. If you're muted, you may want to unmute so you can answer. All right, but first question, true or false? 900 is the highest possible mortgage FICO score. Is that true or false?
False.
False. Correct. If you're thinking false or you said false, you are correct. Right, the highest FICO score or mortgage FICO score, we say 850. I guess we round up a little there because truthfully, we'll see 848 in the mortgage world as the highest score. But, FICO scores go up to 850. But the key here is mortgage score. There's lots of different types of credit scores out there, depending on the transaction you're applying for. Is it a credit card, an auto loan, a mortgage, right? All these different types of transactions can use a different type of credit score. And FICO, Fair Isaac and Company, they're not the only company out there that provides credit scores. They have a lot of competition now. FICO is the major player in the world of credit scores, but there's a company called Vantage Score that's gaining traction and getting more popular. And then there's some smaller companies out there like CE Analytics and other small companies that provide credit scores. So it can be very, very confusing. How about this one, right? When it comes to trying to improve your credit score, all right, what's better? What's going to give you more points? Is it better to pay down your auto loan or your credit card?
Credit card.
Okay. If you were thinking credit card or you said credit card, that is correct. Okay. When it comes to a score calculation, right, there's two different types of debt predominantly, right? Installment debt, those are auto loans and mortgages and student loans where you have a set monthly payment for a set number of months, right? And with those types of accounts, we don't really focus on the balance on that account. We mainly focus on, do you make the payment on time, right? And then the other type of debt that we see on credit reports is revolving debt, right? Lines of credit, credit cards, right? Where your minimum payment will fluctuate based on the balance you carry on that debt. We still care if you make the payment on time, right? That's the number one most important thing. But the balance on that credit card can have a huge impact on your credit score. And we'll talk about that a little bit later. All right, how about this one? Probably one of the most popular questions that we get asked by consumers and people that want to buy a house, right? So if Alan pulls credit on somebody today, right, they apply for a mortgage, but then that same person looks at their scores on Credit Karma, will the scores be the same? Is that true or false?
False.
False. All right, Panley, you're batting 1,000, right? 3 for 3. Great. Right? Different score models used for different purposes, right? Probably the most popular consumer Credit score site out there is Credit Karma, right? People use it. It's free. I use it. I don't have a problem with it, but the score that you see on Credit Karma is not the same score that Alan would see if he pulls credit. If you're viewing this online and you see my screen, I've got a sample of a borrower on the left. We see a mortgage credit score. The mid score is 557. This same borrower, showed us their scores on Credit Karma, and they had a 637 and a 642 score, almost 100 points higher on Credit Karma. So what's going on there? Why are they different? Okay, well, for years and years, there was one key difference, and it had to do with paid collection accounts. The score on Credit Karma, which is Vantage Score 3.0, ignores paid collection accounts. That was a huge deal. It would make a big difference, right? You have a collection account, you pay it, your Credit Karma score goes up, right? And then in the mortgage world, the score that we use would count the collection against the borrower. We don't really care if it was paid or not paid, medical or non-medical, we counted it against the borrower. Well, some new rules happened earlier this year in July, on July 1st, and the bureaus stopped reporting paid medical collections, right? So prior to July 1st, you could have had a medical collection that was paid. It showed zero balance on your credit report, and it impacted your mortgage score, but it didn't hurt your Credit Karma score because Credit Karma ignored it. After July 1st of this year, the credit bureaus stopped reporting paid medical collections. So all those zero balance medical collections, poof, they're gone off the credit report. That helped kind of even it out a little bit, right? Credit Karma versus the mortgage score. Unpaid medical collections are still on the credit report, and they can still impact your mortgage score. Non-medical collections stay on the credit report if they're paid or not paid. They can impact your credit score. Right? We're going to keep that in the back of your mind because we'll talk about this a little bit later. I know you have some questions about that, but I'll answer all those a little bit later. Right? So it's pretty confusing for consumers. All these different scores, FICO 8, FICO 9, Vantage Score 3.0, 4.0, FICO 10 and 10T. All these credit scores exist, and they can be used for all kinds of different transactions. But in the mortgage world, we don't use them. We use a version of the FICO score that was released in 2004. I call it FICO 4 because it came out in 2004, 18 years ago. The technical term for it is version 2.0. But this is the score. Any mortgage company that pulls credit for somebody that wants to, buy a house, they have to have this mortgage score on the credit report. It's required. So confusing for consumers, right? They could go buy a car and that bank or lender could use FICO 8. They could go on Credit Karma and they see Vantage Score 3.0. If you have clean credit, no late payments, no collection accounts, you keep your balances on credit cards pretty low, your scores are going to be pretty similar across all platforms or all variations of the credit score. We start to see the difference when somebody's like newer to credit, maybe they've had credit accounts for less than a year, people that have late payments, people that have collection accounts. That's where we start to see a big difference in credit scores. Okay. Anybody have any questions about that? Good. No. All right. So the credit score pie chart is a very popular chart. If you look up credit scores, you're going to see this pie chart, and you're always going to notice that two pieces of the pie make up 65% of the credit score. All right. The number one most popular ingredient when it comes to your credit score pie is payment history. Pay your bills on time. Right now, we don't really care. You may pay, your mortgage, right? It's due on the 1st of the month, but you may have it set up to pay on the 5th day of the month through online banking. We don't care about that, right? If you pay 5 days late or 10 days late, we don't even care if you pay 15 days late. It only starts to impact your credit and credit score when you pay 30 days or more late. Okay, so if you pay 15 days late, the bank or lender may charge you a late payment fee, but as long as you don't pay 30 days late, you don't have to worry about it hurting your credit score. The second most important ingredient in our credit score pie is, I call it utilization ratio, balances on credit cards in relation to your credit limit, right? That's super important, right? The balance on your auto loan, the balance on your mortgage, does that impact your score? Yeah, a little bit, but the balance on credit cards has way more impact. And we'll talk about that a little bit deeper later in the presentation. The remaining 35% of the pie comes from three pieces, small pieces. And again, for those of you that are viewing online or can see the presentation, what don't you see in that pie chart? There's something that lots of people get very, very concerned about, but it's not part of the pie. Do you know what I'm talking about?
How many times your credit's pulled?
What was that?
How many times your credit's pulled?
Okay, but what's the technical term there? Do you know? What do we call that when credit's pulled?
Card inquiry.
Yeah, the inquiry.
Inquiry.
Yeah, inquiry, right? You don't see inquiries in the pie chart. That small piece, 10% that says new credit, well, inquiries are baked into that 10%, right? Because when you get new credit, the assumption is you're going to have your credit pooled. There's going to be an inquiry, but it's such a small piece of the pie that we don't dedicate a whole piece to it, right? People get all bent out of shape about having their credit pulled. And, oh my gosh, my score is going to drop. I'm telling you, it's nothing to worry about. And something else that to keep in mind is when you apply for a mortgage, that's pretty much the only transaction out there, involving credit and having your credit pulled, where we look at your credit from all three bureaus, right? Alan pulls credit. He's going to pull, we pull from Equifax, TransUnion, Experian, right? We get it from all three bureaus. If you go to buy a car or you apply for a credit card, they're most likely going to pull from just one bureau, not all three. So a lot of times, people get so bent out of shape about inquiries, but again, how many bureaus are being pulled? How much is it going to impact you? It's not a big deal. And something else that we'll talk about later is there's special rules in place for mortgage inquiries, so you don't have to worry about having your credit pulled. All right, a popular program out there, right? We talked about Credit Karma. A lot of consumers love Credit Karma. They sign up for it. I use it. Another popular program for consumers out there that's free and they market it and they say it's going to help raise your credit scores is a program from Experian called Boost. You may have seen the commercials where someone says, hey, I boosted my score 10 points. And somebody else like, oh, that's nothing. I boosted my score 30 points, right? And then they talk about how you can sign up for this free program, Boost from Experian, and raise your credit scores, right? And what this program does is it connects your bank account, right? So Experian can look and see, hey, you pay your electric bill, you pay your cell phone bill, your gas bill, right? You pay that every month through online banking, and it can create an account or a trade line on your credit report. And they say, hey, this will be positive credit. It'll boost your score. Well, yes, it can boost your score, but, right, there's always a but. These accounts, these trade lines don't impact the mortgage score for Experian, right? The old 18-year-old version of the mortgage FICO score does not factor these self-reported accounts into the score. So if you tell somebody, hey, sign up for Boost and it's going to raise your score for a mortgage, that's not accurate. That's not the truth. It will not impact the score used for mortgages today. The new versions of the FICO score, Vantage score, they can factor these Boost accounts into the score and it can improve those scores, but not the old mortgage score. The other thing to think about here too is this is exclusive to Experian. Equifax and TransUnion don't see these accounts. So even if it did boost the score, the mortgage score for Experian, it wouldn't help with Equifax and Experian. Now, I don't discredit this whole program because there are benefits, right? If you have somebody that's new to credit, they don't have any credit, they're trying to establish credit, or if you have somebody that had, a credit issue or challenge in the past, like a bankruptcy or some other, event that damaged their credit, and they're trying to reestablish credit, hey, if they pay their utilities on time, they can sign up for this program. That will boost other types of credit scores, which can allow them to maybe get a credit card or another type of loan, which would help improve their mortgage score. So yeah, there are benefits to this program, but the takeaway is don't tell people to use this program to boost their score for a mortgage, because that's not true. Any questions about that? All right, so I kind of alluded to this news earlier, where, as of July 1st, all three bureaus, Equifax, TransUnion, Experian, they stopped reporting paid, zero balance medical collections. Okay, unpaid medical collections are still on our credit reports. But if it was a zero balance prior to July 1st, those medical collections should be deleted. They should be gone, poof, off the credit report. All right. If you have borrowers that maybe you talked to or clients you talked to earlier this year, prior to July 1st, and maybe Alan or another lender had pulled credit and you knew that medical collections were impacting the scores and prohibiting them from getting a mortgage, it's time to circle back with those people and say, hey, you know what, if you pay or settle those collection accounts, medical only, and they show zero balance, they'll be deleted from the credit report. But there's another change coming early next year. We don't know if it'll be January 1st. We just know it'll be in the first quarter of 2023. The bureaus will stop reporting medical collections that are less than $500, right? So here we are in September, and you have to kind of determine the time frame for the clients you're working for. Are they trying to buy a house this year, or are they going to roll into 2023, right? Because the action you take depends on the time frame. If they're trying to buy this year or get qualified this year, they want to pay the medical collections now and get them deleted. If they're going to roll into next year and maybe buy in the spring of next year, they can hold off on medical collections that are less than $500, because those will be deleted from their credit report early next year, and they could use that money to pay down maybe credit card balances to help improve the score. All right, so please pay attention to medical collections, with the borrowers you're working for or working with that are in your pipeline now. If they have outstanding ones, focus on the balance, decide the path to take. I will tell you, just for how much of an impact this can make on a borrower, a $50 medical collection on your credit report can impact the mortgage score up to 100 points, right? So if you have a borrower that had a 700 credit score and a $50 medical collection popped up on their credit report, it would drop them about 100 points. They'd drop down to 600, right? So it's a huge, huge impact to a mortgage score. All right, so this is a big, big change, something to pay attention to, and something that will help you get a lot more clients across the finish line. And Alan and Tyler and the team at Movement, they know this, they understand it, and they can look at borrowers that have had medical debt in the past, get them to pay it, get it deleted from the credit report. We can wait for it to organically drop off credit, or we could get it done immediately, right? If a borrower pays a medical collection today, $100 medical collection, and they get proof that shows it's zero balance, we can get them deleted from their credit report, right? And that could be a 100-point bump in their score. So that's a huge, huge win for your clients. Any questions about that? Okay. So stats and trends, I always like to keep you up to date on what I see in my world, so you know what's happening out there. Because again, if people don't get past me, right, I'm the first step, right? You got to have that credit score to qualify and get that mortgage loan. So what's happening in my world overall, it's pretty good. Okay, interesting times, right? Average credit scores are at all-time highs. I need to update this because we went from 711 to 714 recently on the average FICO score. So again, average scores are at all-time highs, doing great there. We came out of a period of low interest rates. People were willing to take on debt and borrow because it wasn't costing them that much. Now we're in times of inflation. higher interest rates. We're not sure what's going on with housing. In my market down in Raleigh, North Carolina, we're finally seeing some stabilization where the asking price is typically the selling price, right? They're not going above asking price anymore. All right. So, all right, that's what I'm seeing here. Other markets I hear people are still paying above the asking price. But again, overall credit's good. We can't control the interest rates. We can't control the inventory. But overall credit's pretty good. What I pay attention to the most is balances on credit cards, right? Because people took on more debt and everybody has a different story there, right? Did you do a 0% balance transfer on a credit card and you're paying $500 or $1,000 a month to pay it off before the interest kicks in, right? And that's a good cash flow thing. Take advantage of 0% interest. Or, did you have to charge, a car repair or your child's braces on a credit card and you're making minimum payments and you're paying 24, 25% interest on that, and you're never going to pay that down, right? Everybody's story is different there. But what I really look at is how much debt are people carrying on credit cards and are they making the payments on time? Okay. If we see the average balance on credit cards starting to go up, which again, here it is, we're in September, we're going to get into the holiday season. And I always see the average balance increase this time of year. That's okay. As long as we're paying on time, hopefully paying more than the minimum payment due, and we have a plan in place to pay that debt off. If we're living paycheck to paycheck and not paying down the balance or the principal on credit cards, then we have a problem. Then we start paying late on the credit cards. Next thing you know, we're paying late on the auto loans, and that trickles into mortgage and housing, and then we fall off the cliff. We're not there. Everything looks good right now, but the next 6 to 12 months is going to be very, very telling. I mean, I'm getting reports where I'm saying, hey, interest rates are going to stay where they are, all the way through next year. I see other reports that say, hey, we're going to drop back into the 4s next year. I don't know. Nobody has that crystal ball. We'll see how it plays out. I'm hoping for, a soft landing and we stay prosperous, but we'll see. If you like that information, you want more data from my world and how it impacts your world and your clients, connect with me on LinkedIn. Just look up Jordan Goldberg at Zactus, connect with me, and then read the stuff that I post. I post information about credit and credit scores and how it's impacting, our industry. And again, I don't have the crystal ball. I'm not an economist. I just keep an eye on credit and credit scores. Any questions? Okay. All right, so let's pick on my buddy Dave Ramsey, right? We used to be besties, but not anymore. As a matter of fact, he's banned me from calling into his show. They don't let me get on the air anymore. And the issues with Dave, where we disagree, Dave is all about getting out of debt, right? And not using credit, for any transactions, right? And, I agree with Dave about getting out of debt. That's great. Financial freedom is great. But I disagree with Dave about using credit, right? I think, the credit is needed and credit scores are needed. Dave says you don't need a score. He says responsible use of a credit card doesn't exist. He says there's no good reason at all to have a credit card. I mean, I disagree with all that. And then one of the biggest differences between Dave and I is I smile. Dave's never happy. He's always sourpuss and, grumbly. And I'm like, holy cow. One other difference between Dave and I is he's a multimillionaire and, I'm just a guy making a living. Okay. So, smile a little bit more, Dave. I enjoy helping people. Every day I get the opportunity to help somebody buy a house. All right. And that's pretty satisfying, rewarding, right? My advice to people, and I talk to high school students, college students, realtors, first-time home buyers. I talk to everybody. I'll talk to the person in front of me in line at the grocery store. Okay. But my take is we're a credit driven society, right? It takes credit to get credit. Okay. Living without credit and credit cards is impossible. All right. It's very, very difficult, right? But using credit cards responsibly, it does exist. It can be done. I do it. I'm living proof, and I teach others how to do it. And I'm sure most of you, if not all of you, use your credit cards responsibly, right? Having a good credit score, using credit cards responsibly, it's simple, right? Number one, always make payments on time, right? If you have a Kohl's credit card and you charge $200 on your Kohl's credit card and your minimum payment is 20 or 25 bucks, make that payment on time, all right? All you got to do, you could stop at Kohl's on your way home and pay them $25. You can set up online banking and pay them $25. If you can't pay that whole balance off in full, at least make the minimum payment on time. Hopefully you can pay the full balance due, pay that off, or pay more than the minimum payment so you pay off the balance faster. Second most important is, keep your balances on credit cards as low as possible. Dave Ramsey says, don't use credit cards, cut them up, close the account. No, I don't agree with that. I say, use your credit cards, use them responsibly, buy stuff you can afford, charge the things that you pay for every month, right? You may have utility bills, a gym membership, cell phone bills, gas, groceries, right? All these things we pay for monthly or weekly, charge it on a credit card, right? These are our regular recurring bills. Charge these items on a credit card, get your statement, and pay off that full balance before the due date, right? Utilization ratio on credit cards is the second most important factor on our credit scores. Right. So if I have 4 credit cards with a $5,000 credit limit, that gives me $20,000 in available credit. If I carry a $5,000 balance between all 4 of those credit cards, my utilization ratio is 25%. That's a great ratio, right? People always say, where should my ratio be? How much should I use my credit cards? Well, 50% is kind of like the line you want to focus on. If your balance, and this is cumulative, right? We add up all of your limits and all of your balances, and then we look at that ratio. So if your utilization ratio is above 50%, you need to make some payments and get it down below 50%, right? And then the thresholds you really want to focus on are below 30%. Hey, that's great. Below 25%, you're doing better. But if you want to have maximum credit scores because you plan to buy a house in the near future, you want to have your ratio below 10%, right? So how do you do that, right? How do we work that to maximize our scores, right? Well, think about it. Understand how credit reporting works, right? So here I got, my credit card statement, right? They send it to me in the mail, right? Fidelity statement here. Hopefully you can see it. We get that in the mail, or you get it emailed every month, right? If I have a statement from my credit card and it says, hey, Jordan, your limit is $13,000, your balance is $4,000, right? I set up my online banking to pay that off in full, right? But it doesn't show zero balance on my credit report. What shows on my credit report is my statement balance, right? When credit card companies generate our monthly statement, when mortgage companies, auto loan companies, right, they generate the monthly statement, typically that's the information they send to the credit bureau. So the balance on your statement is what shows on the credit report, and that cycles every month. So if Alan pulled my credit report today, right, there's 3-4 credit cards that I use every month. I pay the full balance off every month. But if Alan pulled my credit, all of those credit cards are going to show my statement balance, probably from August, right? Maybe they've cycled to September, but probably not. They'll probably show the August balance. And that's what impacts my credit score. So if 10% utilization ratio is how you maximize your credit scores, what do you do to achieve that goal? All right. So my Fidelity credit card, right? If I want to be below 10%, I have to log into that account, look at where my balance is, and then make a payment to them. Maybe I pay them more than once a month, right? Some of my credit cards I may pay every week to bring the balance down so that when they generate my monthly statement, the balance on the statement will be below 10% of my credit limit. And that's what shows on my credit report, right? That's how you work the system. That's how you drive scores up. Now, keep in mind, that's guidance, that's tips, that's advice for somebody that wants to buy a house, needs a mortgage, and they want to have maximum scores. If you're not looking to apply for credit or worried about your credit scores, you don't have to follow that. Okay. I don't always do that. I only do that when I'm planning to use credit or apply for credit, and I want to make sure my scores are maximized, right? Do you have any questions about that? Does that make sense? Okay, good. Right, so what kind of advice can we give to clients besides what I just talked about, right? Well, number one is, call Alan, call the team at Movement, right? You're in good hands with them, right? They understand credit and credit scores and all this stuff we're going over today. Every once in a while, there may be something that they're not sure about. They'll reach out to me. They'll reach out to my team, and we give guidance and advice, right? Because the last thing that any of us want to do is give bad advice. A lot of great resources, on this meeting today. Utilize them. Don't ever be in doubt. Just reach out. Right. So I talked about this a little bit earlier, but now I want to know the answer. Right. Does it hurt your credit score if you shop around for a mortgage or car loan? Anybody know the answer?
For a mortgage, no. For a car, yes.
Okay. Anybody else? And so let's just say you've got a client, right? And maybe they talked to a couple other mortgage lenders last week, right? And had their credit pulled. And now today, you're saying, hey, why don't you talk to Alan and his team? I'm like, no, I don't want to have my credit pulled. I don't want my scores to drop, right? Well, there's a special rule. And Pamela, this applies to mortgages, car loans, and student loans, right? Big ticket items. You can shop around, but you want to keep it in a short window of time, a short period of time. Right now, FICO will say anywhere from 15 to 45 days. You'll see some varying answers there. When it comes to the mortgage score, the guidance we give is 30 days. Okay, so if Alan pulls credit on somebody today, maybe they had their credit pulled by two other lenders last week. That's a total of 3 mortgage inquiries, but it's within a 30-day window, so it only counts as 1 inquiry against the scores, right? So as a consumer, you could shop around and not worry about having your credit score damaged, right? But you want to keep it within that short window of time, and we recommend 30 days. Okay, does that make sense?
It makes sense, but why, when you're getting a car loan, if you have 15 different lenders willing to lend you the money, that your score drops?
So a couple things come into play there. One is, remember what I talked about earlier, like mortgage is the only one that uses all 3 bureaus, right? Whereas when you shop for a car, they may shotgun it out and all these lenders may pull your credit. So what you have to look at is which bureau are they pulling, right? And then secondly, if it's within a window of time, a short period of time, and you see your credit score drop, then the question that you have to consider is, are they set up properly? Are they pulling it under the right purpose? Because if it is truly for auto finance or consumer finance, then that window of time comes into play and it shouldn't hurt your score. If you do see a big score drop, then it's possible that they have it the wrong code in play, and then that can impact your score. And that does happen at banks and credit unions, right? You can go in and you want to apply for a loan, and then that loan officer is not available. So somebody else says, oh, don't worry, I can pull your credit, but they pull it for the wrong purpose. It's the wrong use. and that can have an impact on your score. And there's my little disclaimer at the bottom that the attorneys make me put in. So if you need a magnifying glass, go ahead and read that. Another common question we get asked, and we want to make sure that you give the correct advice, is should you close credit cards you no longer use? What do you think about that? Daniel's shaking her head saying no. Why not?
Because you still need lines of credit to get credit.
Stability up
It
and
erases all that good
age-
history.
Say that again, please.
It erases all that good history that you had.
Okay, that's a common answer I get about the history.
One of your items was how long your credit lines are open, wasn't it?
Okay,
Credit.
so if you close a credit card, okay, it stays on your credit report. Okay, it doesn't go away. It'd be really nice, right? If you made 2 late payments on a credit card and you closed it, poof, it's gone. But it stays on your credit report. It doesn't go away. So a lot of people always say you lose the history, and eventually, yeah, it will disappear, right? But positive credit, right? If that credit card, if you paid on time, no late payments, it can stay on your credit report indefinitely. As long as they keep reporting it, it can stay on your credit report. Negative credit history, like if you had a few late payments on there, that can stay on for 7 years, okay, from when you close that account. What you have to focus on when you close credit cards is how does it impact your utilization ratio? Right, go back to my scenario where I had the 4 credit cards with a $5,000 limit, right? $20,000 in available credit. And I'm carrying a $5,000 balance. So I'm at a 25% ratio. Now, if I close 2 credit cards because I'm not using them, I took away $10,000 in available credit, right? So now I only have $10,000 available. I still have a $5,000 balance. So my ratio went from 25% to 50%, and that hurts my credit scores, right? So closing credit cards, always look at how will it impact your utilization ratio. If it's not going to hurt your utilization ratio, then you can move to the next step. And then that's when you want to think about how old is this account? How long have I had it, right? Like I've had some credit cards with banks that have merged and whatever. And I've had them for 20 years, right? I probably don't want to close those accounts, right? Because those are, again, my old accounts. I don't want them to go away. So I use them every once in a while to keep them active. Whereas if I go to, buy my son a new pair of sneakers at Dick's Sporting Goods, and I want to open up the credit card to get 10% off, I can open it, pay off the credit card, close it, and I don't worry about it impacting my credit or my utilization. Okay. Any questions about that? Okay. And the last tip of advice, collection accounts. Should you pay or settle collection accounts? Well, medical ones, yes. If you have outstanding medical collections and you want to get qualified for a mortgage this year, absolutely pay the medical collections and they can be deleted from your credit report. If they're less than $500 and you don't think you're going to buy a house until sometime next year, then you can hold off and ignore those because they'll be deleted from your credit report early next year. Non-medical collections, you have to negotiate, right? You don't just hand over the money because those won't be deleted from your credit report just by paying it. If you have a charged off like utility bill or an HOA fee that went to collections, and you want to pay it, you have to negotiate and say, hey, if I pay you, will you delete it from my credit report? We call it pay for deletion. You always have to ask for that on non-medical collections. Pay for deletion, see if they agree. If they agree, say, hey, you know what? If you pay us, we'll delete from your credit report. Make sure you get a letter, something in writing that says, hey, we instruct the bureaus to delete it from your credit report. Most of the time, there's no issue. They will follow through. They don't do a bait and switch, but you always want to have that letter just in case. Make sure you get documentation. They don't have to agree to delete it, but if you don't ask, they're not going to automatically delete it. Any questions about that? Okay. And always, when in doubt, reach out, call Movement, call Alan and his team. And if they don't have the answer, they'll reach out to me. Right? How do we use this information? How do we have success, sell more houses, make more money, do more deals, help more people, all of that? That's what, the goal is here, right? Well, what do we do? Well, working with Alan and the team at Movement is awesome, right? Because they can do a lot of things that their competition can't, especially the big banks. When they order a credit report, right out of the gate, they could see the credit scores. We also let them know about potential score improvement. We show so much information on the first page of that credit report that's not just a score, right? We may say, hey, this borrower's credit score is 715, but they have potential to get to a 740. And here's what's going on, and here's why, right? And a great example is on the screen right now. I had a borrower that this guy lived in Knoxville, Tennessee, and he had applied with one of those big banks that have a C and an H in the name, and they pulled credit, and he had a 552 mid score. And Mr. Beckwith is just shocked. He's like, no, I have great credit. That's wrong. And, that loan officer at the big bank was just like, well, sorry, you got a 552. I can't help you. Next, move on. Well, the realtor involved said, hey, you know what? If you feel that's not right, let's talk to, this loan officer at Movement Mortgage that I've used for a lot of deals. Let them pull credit, and they kind of have a better understanding of credit. Let's see what they can do. Well, the Movement loan officer pulled credit, saw the same 552 score, but again, they know how to read credit. They know what's going on there. Mr. Beckwith was an authorized user on his dad's credit card. Dad was getting older. Dad missed a few payments. It impacted the son's credit. So simple solution. All we had to do was have the son removed from dad's credit card. So he's no longer an authorized user, no longer impacts his credit. And we got it fixed in less than a week. And he went from a 552 mid score to a 690 mid score. The goal was to be 680 plus. So again, Mr. Beckwith was happy. The realtor was very happy. Loan officer happy. Everybody was happy. We got this resolved. But that's the power and the value of working with Movement and the loan officers that understand credit and credit scores. Simple solution here for Mr. Beckwith, but that loan officer at the big bank had no clue, right? So these are the things that we look for. These are the ways that we help your clients and make sure that nobody misses an opportunity. Any questions about that? And just so you know, I always try to make sure people understand how authorized users work. All right. So I have 4 children, 3 girls, 1 boy. The girls are all 18 and older. Right. And when they, started, doing driving school and, driver's ed and all that stuff, 15 years old, I made them an authorized user on one of my credit cards. Right. Because they're going to, need, down the road, they'll need to buy gas and, I like them to have that credit card. So when you're an authorized user, they're an authorized user on my credit card, that account shows on their credit report. They're not responsible for it, right? They don't have to make the payment. I do that, but it impacts their credit. So I better make the payment on time. I keep the balance low, right? So it's a positive impact on their credit. When they turn 18, they can apply, they all applied and got their own credit cards, but I still keep them as an authorized user on my credit card because it helps them build credit history, and improve their scores. And I know this for a fact because every time they come home to visit, when they're home from school, they like to show me their Credit Karma. And they're like, look, Dad, my score is higher than yours. I'm like, yeah, great. That's because I pay for your student loans and your auto, your car loan and all that stuff. So, but again, authorized user is a great way to start your kids, right? If you're thinking about that, how do I build credit? Or you have some, clients that may have kids and they ask that question. So, hey, parents, if you have a credit card in good standing, make your kids an authorized user on that card. Let them benefit, let them inherit your good history. When they turn 18, they go off to college, they can apply and get their own credit cards. Make sure that they use them responsibly. charge, a coffee, Chick-fil-A, whatever, pay it off in full every month. And again, start them off on the right foot. I learned about credit the hard way, right? My parents didn't talk about it. I went off to college. I got a credit card and I was like, woo, free money. I went to the mall. I bought new sneakers, jeans, everything. And boom, maxed out that credit card. And then it stayed maxed out all the way through college, right? Because I'm a student, right? I couldn't pay it off. That's how I started out the hard way. And the banks love that. But no, the opposite. I want to teach kids how to use credit responsibly right out of the gate. Right. So then as they go through life and they're ready to buy a house, there'll be no issues. Right.
I have a question real fast.
Yeah.
What is the minimum age that you can add a child or a dependent onto your credit line?
I don't know the true minimum. I want to say 14 or 15. I always did it, when my kids were, 15 turning 16 is when I added them, and I never had an issue. But I don't know if there is a minimum age there. I know that you have to be 18 to get your own credit card.
Is there a downside to take them off your credit once theirs is established?
So that's a great question. And it really becomes a matter of how established are they, right? I would
If
say
they have
that-
over a 700 credit score, I pull them off, because now they're 30 years old.
at that point, I'd say yes, cut the cord. At that point, yes. I would say probably the safe time to remove them would be if they've got auto loans on their own, maybe a mortgage on their own. Definitely when they have credit cards on their own, right? But when the auto loans and the mortgages kick in, it's probably a good time for you to remove them. Because one, it's they're probably established on their own, and two, in case you slip up, you don't want it to impact them.
Right. Now, how long does it take the credit to hit once I put them on my credit card?
Usually within a billing cycle, a statement cycle. I would say it would hit their credit once your next statement comes out. And that's something also, certain markets, right? When you're in that, certain markets across the country that have influxes of people from other countries, right? And they've moved to America, establishing credit. They have no credit. I mean, again, these are great ways to build credit, right? They can if they have a relative that'll add them as an authorized user to a credit card, they can inherit that history. Something to keep in mind is one of the unique things about the mortgage credit score is you have to have a 6-month credit history to generate a mortgage credit score. So if you have no credit, 0 accounts, and you open up a credit card, a secured credit card, whatever, you're not going to have a mortgage score until that account has been open for 6 months. Right. So it's not immediate. Like, when you open up a credit card, you could log on to Credit Karma and you'll have a score because they don't have that 6-month history requirement. But for mortgages, you have to have a 6-month history. Right. So that's where the authorized user can help you build that because you'll inherit the original account. But then it's a question you always have to ask Alan and his team. Does the loan program or lender allow authorized user accounts? Sometimes that doesn't count as a valid trade line on credit. And this last slide is just resources for everybody. It's important for everybody to know it's up to us as consumers to monitor our own credit, look for errors and inaccurate information, right? Credit Karma is free. You get alerts, if you had an inquiry or a new account. If you don't want to use Credit Karma, you can sign up for like LifeLock or some other, pay for subscription service. Stick with reputable companies though, right? LifeLock is the most reputable, credit monitoring out there, but you will pay a subscription fee monthly or annual. Annualcreditreport.com. great resource. You can get your credit pulled, from all three bureaus once a year for free. That's a great resource. myfico.com. I love that for if anybody has questions about credit scores, credit information, just go right to the source, go to myfico.com. And the other neat thing you can do there is they have a subscription, program or a one-time program where you can order your credit report, and they actually show you a breakdown of all your different credit scores. Like they'll say, this is your mortgage score. And that is the mortgage score that Alan would see on the credit report if he pulled that credit report today. The score is the same. They also show you your auto loan score, your credit card score. So they give you a breakdown of all the different types of scores that are in use. Again, they have a monthly subscription, or you could do it as one time. So if you have any clients that are on the fence about having Alan pull credit, and they're telling you that their Credit Karma score is good, well, hey, you have to tell them that's not the same score as the mortgage score. If you don't want to have your credit pulled by Alan and his team today, go to myfico.com, pay some money, invest in that, and let me know what the mortgage score is. Odds are they're going to be fine. Most of the time, people that are worried about their credit scores, those are the people that have the good scores, right? That's what I find out most of the time. Any questions? Anything I didn't answer for you, or anything you're curious about mortgages, credit, or credit scores? All right. Well, appreciate the opportunity to get in front of everyone. Thanks for tuning in. And just know when it comes to mortgages and everything, you're in great hands with Alan and his team.
Thank you.
Thank you, Jordan. Just a quick kudos to Jordan. I'm always amazed when I reach out to him when I have a question. I don't know how he's always available, but he always is. I mean, quick, and that
You don't see the ball and chain here on this chair.
Yeah, but he's always really quick, and he actually helped me once. Like I think it was Mr. Beckworth, the authorized user thing, and taking it off, the score went up. I didn't know that. I had no idea. So I learned it from him, and we used that, and it made the score go up when we took off the authorized user on the account. It was hurting the score. So he's a wealth of knowledge. A lot of times when I'm answering questions or giving you information, it's coming from him and his team. So I thank you so much. You've helped me produce more loans and get people's scores up and all that. And I appreciate your time, especially since this is the third one you've done today. So
hey, I love doing it. This is the fun part of my job. So thanks for tuning in.
Yeah, thank you. Thank you very much.
Take care, everyone.
Great.
Thank you.
What else was I gonna say? Kind of going back to what he was saying about the no credit score and Dave Ramsey and all that stuff. Can you get a mortgage? This is actually a question. Can you get a mortgage if you don't have a credit score?
Yes.
Oh, stop.
Yes, Bank of America has a new program. That one joke.
So we can build what's called a non-traditional credit report with it meets certain criteria, pay certain things on your own. Like if you pay health insurance or car insurance, things that you pay on your own, we will take that information and build a score. Or you won't have a score, but build a non-traditional report. So it can work. So Dave Ramsey is right. But guess where the ding is? I'm just going to be, are we still recording? Yeah. The interest rate sucks.
Yeah.
Okay. It's not good. So where, and I know this people love Dave Ramsey, but I would love to live in a world where I don't have to borrow money, but I do. So the ding is going to be, yeah, great. It's awesome. You don't have any credit. You don't owe anybody money except for utilities or whatever, rent, whatever. You're just going to pay on it. We've got one recently where the score, keep in mind, there's a lot of things that go into a score, but to get a halfway decent score, the borrower needs to pay between 4 and 5 points. I mean, do the math. People that don't have good credit or bad credit, or they just don't have all of them, we're talking a lot of money. 3%, 4%, 5% on a $300,000 loan, it's a lot of money. It kills the deal for him. He doesn't have the money. So, so it's possible, but, and I will say recently, things have really tightened up. I mean, I price loans every single day. It's tough. I've got somebody now who is a 735 credit score. They want to do a USDA loan. Usually the sweet spot's around 740, but 735 is pretty close, right? I cannot get a 0-point quote for that person. They're getting a good rate, but they have to pay, I think it was 3 extra point to get that rate. So
Is that because they weren't at 740?
yes. Now I'm gonna get that. Now, remember that part where, I don't know if you guys saw it, but when we get the reports, it'll say what the score is and what you can do. What does it tell you what you can do? We have to click on stuff and look into it, but we can get the scores on. And I know all of you have heard me talk about this ad nauseum, but we're always trying to help people get up.
So if they have 30 days, can you run it?
Get them up, yeah.
Okay.
Now, not everybody has the wherewithal to do that. Most times, but not all, it is paying down a credit card a little bit, this and that. But I actually had somebody once where the prescription was to actually stop paying his credit card off every day. He would every day he made a payment. So Jordan told me, I'm like, when he told me this, I'm like, I believe it. But I know the borrower's not gonna believe this, but he said, go fill up your truck full of gas, 60, 70 bucks, whatever it was, and don't pay it off. And your score will go up. He needed, I think, 2 points to get to the next tier, and he got 11 by not paying it off. So there's all these little tricks that we use to help people get the score up. Because remember, years ago, whenever it was, I've forgotten all the 90s, somewhere in the early 2000s, interest rates are based on exact credit scores, and they go in buckets of 39 points. 620 to 639, it's a rate. And then 640 to 659, it's a little bit better. It keeps going up. As the score goes up, the rate goes down. So even a point, I had somebody once at 679. You just need to be at 680. Would be great if you're putting on 700 or 740. But just getting them to that one extra point increase or decrease the rate.
This is
Actually, cut the rate the same, decrease the point.
conventional loan?
USDA.
On a conventional loan?
All of them. Same thing for all.
So even
Yeah.
government loans?
Yeah.
So 680 the magic number?
740 is really the magic across the
Yeah, that's
board.
the bigger magic.
But we go down to 580 on government loans, but the pricing is terrible.
Right,
That's
but
not-
at 680, you get the break, right? The
No,
interest.
it's every 39 point increment. So, well, except the bottom tier. The bottom tier on government loans is 580 to 619. We will do those. Most lenders won't.
Not to do the loan, that's good information, but I
Yeah.
want to know where you get the eighth of a point, or where do you get the break?
Every tier that you go up. So let's just say we're talking about conventional. For conventional loans, every lender is 620. Nobody can go below it. Government loans, there are some people who do government loans at 500 credit score, but let's just stick with conventional. 620 to 639. That's a rate. And 640 to 659. So depending on where you are, you just have to get to the next tier. It's based on tiers.
Oh, I thought it was
Every
just,
39 points.
Every 39 points.
I didn't know that. Okay.
Yeah,
I thought it
620
was-
to 639.
It was 680 and then 740 was the next break. I always
No.
thought that.
If you're 740 above,
Your goal.
you're going, yeah, it doesn't not, and I have people say, oh my gosh, I'm 748, I'm gonna be 800. Why? Why?
Competitive with.
What are we gonna do? We're gonna do something to make that the same rate. Doesn't matter. It's inconsequential.